Hello everybody, welcome back to Financial Options with Thumper. And today's a special treat. I'm actually going to be talking about some plays I plan on putting on next week. Whereas normally I put on my trades and do a weekly review at the end after I've done the trades. This time I get to get a little insight into my thought process going into the week. And I'm making this video mostly because it's a different type of strategy I'm going to implement for next week. And I wanted to make a video so that the people that I collaborate with can watch it and see exactly what I'm trying to do, why I'm making these decisions, so we can, jumpstart that conversation of like what they think about these kind of plays coming up. So I'm normally an option seller, but I'm seeing an opportunity to buy some premium here, and because of that, this video might attract a different audience. So I want to take a moment to say hello to anyone that found this channel due to this video, and say welcome. The purpose of this YouTube channel is to teach people how to use options to empower themselves, and I'm mostly a premium seller, and if that interests you, please go watch some of my older videos. I go from the basics levels to really going into every trade that I do, and on a weekly review, a lot of content out there for you to consume if you want to try learning options, or maybe learn to become an options seller. So with that out of the way, let's go ahead and jump into this big change that I'm looking at. So a lot of this is sparked by the fact that the VIX is going down. We know the VIX is a measure of implied volatility, and the higher that the VIX is, the higher the premium is for selling contracts, typically because it implies more risk. And we know that the realized volatility is usually less than the implied volatility. Well, right now, the VIX is getting down to below 15, so premium is getting pretty tight to find. I'm having a hard time finding new plays to sell where I think the risk that I'm taking on justify the rewards I'm being given. If you know me, I'm a poker player. I look to put my money in to into good opportunities where I get good pot odds kind of thing, and it's been a hard time finding good plays that return enough money to make me pull the trigger on stuff. Now the VIX is down to 14. If we go back to before the whole pandemic spike, 214 here, we're at 14 over here. So I just want to point that out. If I'm having a hard time finding plays to sell premium, then one could assume that means buying premium might be a good move or something worth looking at. And so that's what I decided to do this morning at 5 o'clock in the morning, over here looking at VIX and trying to find plays where I might convince myself to buy some premium. Now, the reason why I think this works is doing a little case study. Let's go back. I wanted to show Microsoft over here. So how can I buy premium and not be trying to time the market? I think the answer is going to be Leaps, and here's a little case study. Before this Black Swan event in March, where we all know March 23rd, everything dipped like crazy. If you sold puts over here, you got smoked. If you bought calls, you got smoked. There's so many different option strategies in the short range that you had to figure out where the top is, where the bottom is, try to time the market to get in and out. But one thing that you didn't have to try to time the market would be buying Leaps. So Microsoft here, let's say you bought a Microsoft Leap at 220 right at the peak here. Microsoft at all-time highs, and you're buying some calls right here. And I'm gonna do some on-demand futures here at Thinkorswim and pull this up real quick. I'm gonna change this, and I think that was February 22nd was the peak, right? I'm not sure. February 21st. We're gonna go over here, make sure that this is reset, and we're gonna go ahead and buy Leap on Microsoft. I'd like to go as far out as I could, so here we go. Wait for this to finish. All right. Me, I like set them up for a PMCC, so I'll be looking at something that's 0.81 delta, or 0.8 delta or better. So I'm just gonna go ahead and we'll buy this 125 call. So buy and confirm and send. Okay, so we got that taken. Now I'm going to take this and jump forward in time to today, or I guess Friday. Alright, so now that that's finished, what you can see is if I just bought that and just held that through that entire scary dip, obviously we made a lot of money over here. The P&L, we made 9,000 bucks here. If we go ahead and calculate out the return for that, 9037 divide by, we got filled at 6188. And if we bought a Leap at like the worst possible time in February at all-time highs, like we made 146% return on that investment. So like Leaps, I mean, I love Leaps. If this doesn't prove why, then I'm not sure how I can convince you that Leaps are awesome, but here you go. This is why I'm not opposed to buying Leaps, because you can hold them. You have plenty of time for stuff to go up. Because they're leveraged, you can get huge returns. As long as you can hold them through those giant dips. If you were paper handing it during this dip and you sold, you locked in a loss, whereas you had plenty of time for it to come back. We still have time for that play that we just tried to come back. So this is why I think Leaps are the way to go, especially in an environment where VIX is low. Remember, VIX at this time was at 1450 or so, and we're back down to that range right now. So buying Leaps seems like it could be a good play. Now I'm going to turn off the on-demand here. Alright, so one of the Leaps that I'm looking to buy next week, or this week I guess, would be Coke. And if you know me, I play Coke all the time. I like Coke. I'm pretty bullish on them. Looking at the 2-year chart here, and here's the volume profile. You can see there's been a lot of volume at the 53, 54 mark here. And over here, we're above 54 now, so we're above that little like support going back 2 years over here. And if you're looking back before the March dip, like they show that they were growing, they were up to $60 before the March dip. So I think they're kind of back to that level where they were before, and I expect them to go back up. So why not buy some Leaps? Going to the actual trade itself, and it's up to the calls. I like to buy Leaps as far as I can. It gives me more time to be right. And I like to buy them at a higher delta, because if I want to later, I could turn it into like a PMCC. So what I'll be looking at is at least 0.8 delta. So 42.50 here would be where I'm going to be looking at. And the delta, for those of you not sure about what that means, it's a measure of how much the price of this contract should increase should the price of the stock move up $1. So if Coke goes up to 55.18, I should make $87 off this stock, or off this option. And it also represents like a probability of being in the money, so 87% chance of it being in the money at expiration. But let's be real, I probably won't be holding it that long, even though I'm buying out that long. So this would be what I'd be looking at, is the 42.50. And the price I'd be targeting would be something to get like minimal, extrinsic value. And unfortunately, the spread of this is so huge for the 42.50. It's tough to predict where that feels going to be. But one thing I can tell you is it's going to be at least the intrinsic value. So we have 54.18 is the stock price. Subtract my strike price, 42.50. And I think my minimum fill, or the real bid, would be 11.68. Since we're 2 years out in time, there's going to be some time premium. I'm going to move this down here. So I think the real bid and ask is between these 2 points. So if you're looking for like a midpoint between these, so maybe like a 12.25, 12.30 fill would be what I'd be aiming for the 42.50 would be my target. So I'll come market open, I'll be putting up a bid. I'll start at the 12.25 and see if I get a fill. I might buy 1 or 2 of these contracts. Remember, Leaps are pretty leveraged instruments. Like, you don't have to buy a lot to see a huge return. So limit yourself to like 1 or 2 contracts. You can always add more later if you see a dip and you want to double down on it. But that's what I'm going to be looking at for one of my plays. Another play I'm going to be looking at is VST. And this is a energy company that's mostly based in Texas. And it's kind of a new play that I haven't really played with before. But just looking at the chart here, I just like what I see. So going back in time, well, let me even put this at the 5-year. Let's go back further. Oh, I thought I had the 5-year set up. All right, we'll just do the 3-year. So even going back 3 years, you can see they consistently trade at the $23 mark, going from, the 2018 year, 2019. That's awesome. During the March dip, they got hit hard, but all energy got hit hard at this point. They recovered some of that back. They showed that they can get back up to 24 already. And then I think they had some news with some blackouts in Texas that caused them to get a big dip here. So I think we're at a buying opportunity for this company. 2018, 2019, they were well above $23 a share. Going over to Yahoo Finance. If we take a look, their market cap is only $9 billion, which is, I mean, pretty low for stuff that I usually play on. But if we look at their financials, like their revenues and earnings, in 2018, $9 billion, 2019, $9 billion or $11 billion. So like they're increasing revenue for the most part. The other thing to know is like their earnings has been going up as well. So in 2018 and 2019, with the same revenue that they're getting now, essentially, the stock was sitting at 23, $24. Why are we sitting at 19, even though they show consistent revenue and earnings here? So that's kind of why this one sparks an interest in me, is I feel like it's just a little undervalued in their stock price right now when you just look at those metrics. If you go to their website, you go to investor relations and do your own like research here, which is pretty cool. And they have presentations where they go over all kinds of stuff that they have. One thing I do like is they're reducing their emissions consistently throughout the next couple of years. They make a note that they are growing customers year over year. They have a good mix of like residential and business. Even though they're mostly a Texas, they're viewed as a Texas company, they do have assets outside of Texas. So I kind of like that diversification over there. Anyway, going back to the options chains over here. What would I be looking at? Well, the first thing I like to do is go out. Well, I think I kind of made it clear that I think it's going to go back up to like $23 pretty easily. So I'm going to go to the trade. Change this to VST. Go out as far as I can. One thing I note here is that it looks like they only sell monthly option contracts. So that's, I mean, for the Leap, what we're doing here, that doesn't affect me, but since I normally sell Portman covered calls, that's just something to note if that's what you're looking at. So the first thing I'd be doing is looking at 0.8 delta. I'd be looking at the 13, maybe the 10. I'd probably eye the 10 first because it just looks like it could be a good candidate for like a PMCC. But after I went through and figured that out, I used my little spreadsheet here to see if it would be a good PMCC candidate. And I was looking at the numbers, and for selling a month out, or actually I think this was 45 days out, you only get $35 return per contract. When you consider that you're buying it for $10 each, which was the target I thought I could get a fill at, it doesn't seem like a huge return. So I'm not setting this up to be a PMCC, which means I might be more willing to go to a higher level support to lower the amount of capital I'm putting in the position. So looking at this, it looks like you can get down to like 15 here. Hasn't been to 15 for a long time. So that would be where I'm looking at now, because I know this is not going to be a PMCC candidate for me. I'll be looking at the 15 strike here. And my break even, 15. Say we get a fill between the mid price here, which would be $5. So say our break even's 20. We still leave room for the Leap to gain value, like when it goes back up to 23 or so forth. So I think this might be where I end up buying. And because it's a smaller delta, I'd only make 74 cents or $74 per dollar move that it makes. But, I'm using less capital to make that trade in this instance. I might put on 3 or 4 of these contracts and just let it sit there and see what happens on this. Because I think it could be a nice low cap bullish company that we can make a nice little return on. So with all that said, if you enjoyed this video, please like, sub, subscribe, share the video. What are your thoughts on buying Leafs in a low VIX environment? Leave some comments. I love to respond to comments. And if you like this type of video, let me know, and maybe I'll make more of these in the future. And I hope you guys had a good 4th of July, and good luck next week. I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.